market measure that our research team put together for you. How can we quantify risk during earnings periods? We talk about risk as a fundamental aspect of investing. And when we get into earnings seasons, it's when, I don't know, there's a little more heightened volatility. Along with heightened volatility comes sharp price swings and also a lot of, uncertainty whether they're going to maintain those rallies. Like in Tesla, they did maintain the rally for a couple of days. Today's day 3, by the way. I actually don't like Tesla here. With the help of back testing found on Tasty, which we now have on the web platform, we grouped stocks in 4 groups based on their product and examined how we can quantify risks of earnings season. Not the easiest thing in the world, but let's take a look. 2018 to present, so 6 years worth of data, 16 Delta Strangle. We're going to look at a bunch of different sectors: the tech sector, the consumer retail, the entertainment sector, and the automotive sector, and then calculated risk by using different risk metrics and then compared the results. It's a really good study the team put together. So the first thing we see is since 2018, we've been able to observe the timing of most earnings announcements, and this enables us to evaluate their influence on stock volatility and risk by randomly selecting stocks from the top of the S&P 500 that are available in our backtesting tool. We can perform case studies to explore the effects in greater detail. And so, this first slide is just all the different earnings trades, just showing that we have lots of data, nothing more. Let's go to the next slide, John. This is where we start to get into the meat. During earnings season, tech and semiconductor stocks like Apple, Google, and AMD show a solid average win rate of 70%. Don't forget, this has been since 2018, so it's been a pretty good market. However, the risks are high, especially for Google, with a max loss of, this number doesn't mean anything because it's a one lot of 3,600, and significant volatility. AMD with the lowest volatility and the lowest C-bar appears comparatively safer. The risk-adjusted ROIs are 19%, indicating decent returns, but with notable variability. So essentially, looking at 6 years worth of data here, and just looking at the tech stocks, we threw up some interesting, things like, okay, let's sell the 16 Delta Strangle. You end up with the win rate of 70%. You end up with a max loss. Obviously, that's pretty high. The max loss as a percent of the buying power is 19%. The C-bars, which doesn't seem too bad, is $1,800. The risk-adjusted return on investment, which coincidentally is also 19%, and the volatility of P&L is plus or minus $1,000. Okay, so that's, 19% return for, that's your earnings season. All right, not bad. Let's go next slide. So we did the same study for consumer stocks, which have a much lower implied volatility, right? Like Nike, Amazon, Costco, they have a win rate is really solid, 73%. However, there were some big losses, specifically in Amazon. And when we did the whole thing over a period of time, because you can't just cherry pick, we found that the return on investment was very modest at 2%, showing that, these were tough stocks, not worth the risk. The volatility of P&L was 4,000. The volatility of P&L tech stocks was only 1,000. So the difference here is that you made a lot less money, you took a lot more risk, and it wasn't a great sector for risk return. Just, simply put, it just wasn't.
Yes, correct.
If you go to the next slide, now again, we're just trying to quantify risk. We're not trying to say this is easy or it can be done, in the future. This one here, when we looked at entertainment stocks, we looked at, Netflix, Meta, I'm not sure I would call media, and AMC, throwing that in there. And the average win rate was a lot higher. The average the C-bar was lower, and the risk-adjusted return on capital was highest at 21%, and the volatility P&L was significantly lower at only $1,200. The media stocks, AMC, Netflix, and Meta, was was probably the best of anything we've looked at so far, better than technology and better than the consumer stocks by a long shot.
Yeah. Yeah.
And if you go to the next slide, John. So this one's interesting because we looked at automotive and we said, okay, well, how well did Tesla, Boeing, and Rivian do? You know, just trying to grab some stocks.
Now you're in the stocks we trade, right?
Yeah, we trade. We have positions on in Tesla, Boeing, and Rivian for sure. Rivian, we're smaller in there because it's only a $10 stock now, but over the last 8 years, it's been significantly higher. Tesla for the high risk tolerance and potential returns, Boeing for moderate risk with stable returns, and Rivian, you know, for lower price, let's call it, lower risk investment. What's interesting here is that the C-bar was significantly higher. The volatility of P&L significantly higher. The win rate was about the same, and your return on investment was negative. So part of that's Tesla, part of that is, you know, part of that's Tesla, part of that's Boeing, which had some big moves, but the risk return is negative. Before we go to the takeaways from the research team, let me give you just a few of my takeaways from this.
Okay.
I don't think you can look at any sector and say, you know, going into the future, 5 or 8 years from now, 6 years from now, whatever, that this trend is going to continue. What I think is interesting is that there are multi-year sectors here which have done better than others, but generally speaking, the return on investment has been on earnings plays has been what I would call very marginal, meaning that 2 of them were basically, you know, one was unchanged, one was negative, and 2 were in the 20% range. Given the risk that you're taking and given all what they called here the variability of these different things, there's not a lot of evidence here suggesting that for the risk you're taking, you got a huge reward.
That you get the bang for your buck, the whole volatility contraction, the whole enchilada of strategies moving very quickly in one day.
I kind of feel like there's nothing here that stands out to me that says, you know, that these are great dues, and there's nothing here that says to me that they're not worth doing. You know, I mean, they're an engagement tool, like we've said all along. They're fairly priced, they're random, they're an engagement tool. Let's see what the research team had to say. There was a tech semiconductor. Okay, I missed that. This is just an overview of all of them. And so you can see the win rates across the board, all in the same category. The max loss is pretty wide. The C-bar also pretty wide. And what's surprising is that before you looked at this, you would have guessed that the tech semiconductor space would have been the riskiest, and it turns out it was the least risky for the best return, and with the lowest volatility of P&L, which is really surprising. So in other words, you look at this and you're like, what I thought would be the riskiest was the least risky of the group. Let's go to the last slide.
Go figure, right?
Right. So in our previous study, we quantified stock price movements during earnings season and assessed the performance of defined versus undefined trading strategies. This study focused on quantifying the risks associated with the earnings announcements, which is essential for traders. Earnings season increases investment risk due to heightened volatility, especially in sectors that are more volatile. Stock movements depend on how earnings results compare to market expectations. To manage these risks, investors should diversify their portfolios, trade smaller positions, and use, you know, mental stops, I would say, when necessary. The stocks analyzed are examples of our backtesting tool, categorized by products and services they offer. You can also use this tool with different stocks to assess their risk, reward, and volatility. We've been spending a lot of research effort using our own tools because we want to show you what you can do with the technology that we've built. Again, to me,
you're talking about the backtesting tool now on the web of Tasty Trade, correct?
Yeah, but to me, these results show a lot of randomness, and they show risk where you didn't think there was risk. And if you go back one slide, John, to slide number 8 for a second, you can see here that, I mean, you would just think that consumer retail would be, I don't know, the most boring of all those groups, and
sure,
it had the most risk, and the tech would be the riskiest, and it had the least amount of risk. So it's not always as easy as it seems. I'll just leave it there.